In this video, we're going to talk about housing. We're going to talk about how bad the housing crisis is now estimated to get, how much it's already fallen, some new warnings from the Realtor Association. Imagine that, the Realtor Association actually giving a warning about the housing market. We'll talk about exactly what goes into the pain that we're experiencing, and we'll talk about which areas are just getting whacked the absolute most, as well as where some folks are potentially getting bulk deals and discounts to buy real estate in bulk. Welcome back, everyone. I'm Meet Kevin, and let me ask you this. Do you know what could cause banks in China to collapse? Well, if you take a look at this particular Bloomberg article here, it says that thanks to the housing slump, where home prices have already fallen by some accounts over 30%, by some accounts up to 37%, housing could potentially start taking out some of the smallest banks in China, with, in one scenario, 15% of small banks going bankrupt. Housing is a big deal, not only to the Chinese economy, but also to the American economy. And of course, this video isn't about China, but boy, oh boy, we've got some things to talk about. Let's go ahead and start with the Realtor Association. Look at this. The Realtor Association, on October 12th, that's today, made or provided an update and suggested that mortgage rates will likely resume their upward trek this week, moving closer to the 7% threshold. Well, golly, if you already type into Google mortgage rates, you're already going to see that mortgage rates are sitting at about 7.4% with a forward trajectory. But of course, the Realtor Association likes to use backward-looking data, so we're not quite there yet. Now, the Realtor Association goes on to say that data suggests that inflation will remain elevated, putting additional upward pressure on rates. They say that job growth continues to be strong, and producer prices for goods and services, which data came out this morning, rose for the month. That is, rather than inflation going down, it actually went up more for producers or sellers of goods and services. While producers typically pass on the increases in production prices to retailers and consumers, producer price fluctuations serve as a good indicator of inflation to come. As a result, the director of forecasting, a senior economist at the National Association of Realtors, is warning that we should stay tuned because we're about to potentially see even higher rates. Now, one of the issues with rates is not only people getting screwed, like home flippers getting screwed, which is probably the worst market to be flipping in. By some accounts, Open Door is losing money on 42% of their flips. In some markets, like in Arizona, they're losing money on as many as 72% of their flips by some third-party researchers. We are seeing a lot of pain, and that pain could worsen as rates continue to rise. Remember the formula of 10x. For every 1% rise in interest rates, buyer purchasing power goes down by about 10%. Given that interest rates were sitting at about 2.8% in December, and now here in October, just 10 months later, 10 and a half months later, they're sitting at 6.8% at least, if not more, closer to 7.5% by some accounts. We're probably losing somewhere between 50 to 55% of buyer purchasing power. But that's not the only thing that actually affects real estate pricing. See, there are four pillars for how the real estate market and its pricing is determined. Number one is supply, number two is demand. Now, these are considered your sort of structural aspects. These generally have to do with how many homes are actually available, how many houses or how many households are available or looking for homes. And when you have a supply and demand imbalance, you could see prices rise over time. Now, typically, we see prices rise in conjunction with interest rates going down because people can afford to pay more, and there's a lack of supply. Well, now we have the other two pillars getting hit. So if pillar number one is supply, pillar number two is demand, the other two are affordability and credit availability, or in other words, the ability to make your payment and actually afford the property, and the opportunity to even get a loan in the first place. And while supply and demand are really quite entrenched right now, the two that can affect prices in the near term, according to most economists, are mortgage affordability and, of course, credit availability. And if we take a look at some of the drama that we're seeing right now in markets, we can see some real pain. First, we know that home buyer affordability has plummeted to lows that we have not seen in over 40 years. This is absolutely ridiculous. The red line here represents homebuyer affordability, and we have not seen such a rapid deterioration in homebuyer affordability in 35 to 40 years. In fact, affordability compared to January has fallen by over 50% year over year. During the great financial crisis, the declines of homeowner affordability never exceeded 30%. That's nearly half of the decline in affordability that we're seeing now. Basically, what we're saying is, for the 10 years of a real estate bull run that we had, with the money printer going burr and rates really low and trending towards zero, we took all of those 11 years of easy money policy and easy affordability and turned it into 6 months of hell. That is, in 6 months, we saw affordability get completely crushed. And it's very painful. So mortgage affordability has absolutely been destroyed. And now we're starting to actually potentially see changes to credit availability. And this is quite logical. According to the CNBC article, mortgage credit availability is now at the lowest level since March of 2013, which is when housing was in a slow recovery from the financial crisis at the end of the prior decade. It fell for the 7th consecutive month in September, now down 5.4% just from August. It means in a 1-month period, mortgage credit availability fell 5.4%. And this is despite the fact that CNBC here says mortgage lenders may be desperate for business as mortgage demand drops due to higher demand, but they are also now more concerned about a weaker economy, which could lead to higher delinquencies. And this makes total sense. If you were a lender right now lending money to people, or you were a local credit union, do you want people walking in going, hey, I barely qualify for this home. If home prices go down and I'm putting 3% down, I might walk away because I'll be upside down. But in the meantime, would you mind lending me that $600,000? Yeah, no. Now, sometimes you can, like, going into a housing crash, like while prices are kind of peaking and affordability is falling, like what we saw in the summer and spring, prices peaking, affordability like zero because affordability had already crashed. You sometimes see programs come out like Bank of America's 0% down option, where you actually see lenders loosening credit availability. But I think that was just an inconvenient time for Bank of America, and even though that went viral, it's not usually what happens during this part of the real estate cycle. See, something we talk about in my courses on building your wealth, specifically through real estate. Remember, I'm the founder and CEO of HouseHack. If you're an accredited investor, you can invest in this. But also in my courses on building wealth through real estate, whether that's property management, real estate sales, do-it-yourself real estate investing, going from zero to millionaire. Everything has to do with the real estate cycle. And as the real estate cycle turns down, you generally see less availability of mortgages. That's because lenders get nervous. And this makes sense. Why would banks want to give out risky loans during this time? It's better to give out safe loans during boom time, because even if you gave a loan to somebody who wasn't as qualified as they should have been, as long as the price went up, things were okay. That's what was said in 2006 and 2007 as well, is people would always have another opportunity to refinance. Now, don't get me wrong. Credit quality is way stronger today than it was during 2007. This is not another 2007. It's very different from 2007. And now I don't like to say this time is different, but let's be real. Mortgage quality is 10x safer today than it was in 2007. But what we have that's different is the utter collapse of mortgage affordability. We have more fixed rate loans, less variable rate loans and ninja loans, no income, no job, no asset loans like we had in the last crash. But which all of that, of course, led to short sales and foreclosures and all that. But we're in a situation now where we see buyers are just essentially locked out of the market. It's very difficult to buy right now. And this is why we're starting to see changes in supply. That's the next phase. What you see mortgage availability tighten because credit availability goes down. Buyer purchasing power goes down because interest rates are going up. Then supply starts changing. But not because more people are selling. It's actually because less people are buying. And see, this is where, rather than just measuring the nominal number of homes on the market, it's actually really important to look at something known as the month's supply of homes on the market. And when we look at the month's supply of homes on the market, we actually see a metric that's rising. Right now, we're at the highest level of homes on the market that we've seen since July of 2020. It's not really that big of a spectacular number, but it's very important because the way supply of homes on a month over month, or sort of how many months of supply we have is measured, is you simply take the outstanding supply of homes and you divide that by the number of homes sold in a month. And the reason that's a really important ratio is because if the number of homes sold per month plummets, then the denominator gets smaller. And when the denominator gets smaller, the end result gets bigger. In other words, you have more homes available for longer. That's because you're actually selling less homes. So even though you might see low supply, you could actually still see the month of supply or how many months of supply we have available go up without actually seeing more homes hit the market because less homes are selling. And when months supply goes up, the next thing that usually happens is prices fall. Now, we've already talked about how prices have moved so far. Prices so far are down roughly about 6.5% across the entire country. In some areas, prices are actually down more than that. But that's from peak, from about March. Now, we'll talk about some specific areas in just a moment. But what's important to know is it takes a while for all of these sorts of pain thresholds to actually really manifest in the real estate market. Again, you get buyer purchasing power going down. That's because interest rates are going up, right? Then you get banks start getting nervous and they actually restrain buyer demand even more. Then you reduce the volume of properties sold. When you reduce the volume of properties sold, houses stay on the market longer, more supply of homes for longer available. And then sellers who have to sell end up having to drop their prices. And that's how we slowly start seeing price drops. That's why we've already seen about 6.5% price drops nationwide since about March to June. Every different areas kind of peaked out at different times. Now, one of the reasons we're not actually seeing this big surge of sellers all of a sudden wanting to sell is because of something known as the lock-in effect. This is basically where you ask yourself the question, why would you sell in this market? Like, why would you sell if most people have locked in a mortgage rate of under 4%? Refinances are virtually zero. Over 90% of homes have rates of under 5%. Why would you sell? Well, the reasons you might sell would be job loss, which we might see happen more so because of the economy that we're going into, but we haven't started seeing that yet. It's not a very strong labor market. You could probably lose your job and still get another job pretty quickly. We've seen the potential increase of inventory from natural things like divorce or death, which those are unfortunate circumstances, but those could lead to sort of a forced selling. And then generally those individuals either move into a different property or move into a rental property. You do see some investors, though, decide that they want to sell their rental properties because keep this in mind, up until recently, in some markets, 1 out of every 8 home purchases were to a flipper. Nationwide, 1 out of 10 home purchases were to a flipper. Those people, like Open Door, have to sell. You could also see a lot of the people who bought up homes for short-term rentals decide, you know what? It's time to take my profit on this puppy and wait out this recession. Or go buy the dip in the stock market. That's what a lot of people are doing as well. They're dumping their homes, putting it into the stock market so they can lose even more money with the hopes that eventually the stock market will recover before the real estate market does. Because that's usually what happens. Consider the stock market bottomed in February of 2009, and the real estate market bottomed 2.5 years later in about November of 2011. Now, you've also recently had about 1 in 5 homes sold to institutions. In some markets like Miami, 1 in 4 homes were being sold to institutions. Some institutions, especially pension funds, might actually be forced to sell properties because their bond portfolios and equity portfolios are getting completely decimated. So rather than sell bonds or sell their stocks and equities at lows, they could break the piggy bank, so to speak, of real estate. However, it takes time to sell real estate, especially if you're a pension fund with thousands of homes. So, do we expect to see price drops like the global financial or the great financial crisis? Probably not, but we do expect to see some substantial pain, mostly because while we don't expect a short sale and foreclosure crisis, which is where prices fell 40 to 50%, because after all, when you're doing a short sale or foreclosure, you don't care about how much of a loss you're taking because it's not your loss, it's the bank's loss, right? And so those short sales really tanked the market in 2008. We don't really expect to see that kind of disaster again. While it's entirely possible, we expect more of this kind of crash, depending on whether or not we have a recession. Take a look at what Mark Zandi says, an economist who studies this pretty regularly on Twitter. He mentions here that sellers are caving. They understand that potential buyers can't afford the price they want due to the surge in mortgage rates, the price the sellers want, right? And unlike times in the past when rates rose, they know they won't be coming down anytime soon. And so sellers could also be motivated by fear. There's that word. And we're going to have real fear, by the way, when we actually not only start seeing these month-over-month declines, which we're seeing now, but when we actually do year-over-year comparisons and we start looking from a low to a peak and we go, oh my gosh, year-over-year prices are really coming down, then I really expect fears to explode. But anyway, Mark goes on to say here, buckle up, he says, assuming rates remain near their current 6.5% and the economy skirts a recession, then national home prices will fall almost 10% peak through the trough. Well, we've almost hit that because we're already down about 6.5% nationwide. Now, most of these declines will happen sooner rather than later. Exactly, we've already seen that. However, he does say house prices will fall 20% if there's a typical recession. Now, I usually find that Wall Street economists tend to be pretty lowball on their actual expectations of how long pain will last. It seems like economists are this breed of optimists. And the reality is, the difference here is what you want to pay attention to. If you think we're actually going to have a real recession and the Fed is going to push us through and drag us through a recession with real sustained rate hikes, yeah, we'll probably have a more substantial fall in real estate prices. Now, we'll look at some specific areas in just a moment, but what's worth remembering is no matter what, if all of a sudden tomorrow inflation comes in at, let's say, 5% and the Federal Reserve says, you know what, we're not going to raise rates anymore, we're done, we're doing a 0% rate hike, we could see mortgage rates plummet very quickly. And we could actually just see what will end up proving to be a temporary dip in the real estate market, where you kind of see like this 6.5%, 8% decline, and then it's kind of back off to the races and money printing because the Fed screwed up. That's possible, but that's a very rosy outlook. And so we have to be prepared to react, not based on what we believe, but what the Fed actually does. So, I'm ready to move. If tomorrow inflation plummeted to say 5% and then it went down to 3% by the end of the year, and the Fed's like, we're done with rate hikes, heck, I might consider going shopping for real estate now. And remember, I am leading this startup, HouseHack, househack.com. If you're an accredited investor, I highly recommend you check it out. Read the subscription agreement and the private placement memorandum. This is not a solicitation. That website is. And learn more about how you can join and get founder shares. Just make sure you join by Halloween and send your wire by then too, because that's how you're going to lock in the greatest benefits. Now, what's also very important is where are potentially the greatest deals happening? Well, it depends. Some markets are really suffering a lot more than others. Some areas like Austin, Phoenix, Seattle, and San Diego, some of these high-priced areas, San Francisco, they're already seeing substantial declines in prices to where some of these areas are already negative year over year. Nationwide, we're not, but some of these areas already are. Not great. But what's more interesting is actually the areas that potentially still have pain ahead of them. Take a look at this particular chart here. This is a chart from Merrill Lynch about which areas are potentially the most overvalued. The top ranked most overvalued city is a Zoom town called Boise City, Idaho, followed by these other areas here, including Flagstaff, Arizona, some locations in Florida and Texas. There's Idaho Falls is on here as well. Wow, I've been there. Cleveland, Tennessee's on here. Vegas and Henderson is on here. Flint, Michigan is over here. I wonder if they still have lead in the water. Okay, bad joke. Sorry. Spokane, Washington is on here. You've got some big names on here, some very well-known names. I was just in Spokane. So we have to be prepared. And the biggest thing that you want to pay attention to is the Federal Reserve. Now, how can you be prepared to buy real estate? Well, increase your income, lower your monthly debts, and consider joining the programs on building your wealth, specifically the Zero to Millionaire Real Estate Investing course. Use the coupon code before Friday at 11:59 p.m. because we are ending lifetime access to the live streams for anybody who joins after that, specifically for the Path to Wealth course. Thanks so much for watching. Folks, check out the links down below, and we'll see you in the next one. Good luck and goodbye.